Warren Buffett started investing when he was 11. He soon started experimenting with timing stocks, charting, and all sorts of things related to investing. Buffett found enjoyment with these activities, though he did admit it was profitless but fun. He did these exercises until he was 19, and he's read almost all of the investing books from the public libraries. He found all of it fascinating, however, he had no framework. It was like he was searching for something that would tell him about how stocks function or how he can make profit out of them. Luckily, in 1949, Warren Buffett read a book by Benjamin Graham titled The Intelligent Investor. The book only had 2 chapters, and they set the philosophical framework for Buffett's investing techniques. These key principles are basic and simple and will tell you how you can apply it in your investment journey. Hey, welcome to Stock Market Mate. In today's video, we'll talk about Warren Buffett's 3 major investment rules for beginners. Before we get into it, make sure to subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Warren Buffett follows a few important tenets and investment philosophies that are widely known to be effective. Specifically, he follows Benjamin Graham's school of value investing. The first key principle that Buffett follows is knowing that a stock is part of a business. You can't see a stock as something that is different. He claimed that you must value the business and divide by the shares outstanding. However, you must pay great attention to what kind of business you're getting into. What are its economic characteristics for its competitors? What is management like? All of these things that relate to the business must be given attention to. Simply, Buffett views each company as a whole, so he chooses stocks solely based on their overall potential as a company. Holding these stocks as a long-term play, Buffett doesn't aim for capital gain, but ownership and quality companies extremely capable of generating earnings. When Buffett chooses to invest in a company, he isn't concerned with whether the market will eventually recognize its worth. He is concerned with how well that company can make money as a business. You must look for something that ensures competitive advantage. A competitive advantage is simply a factor that distinguishes a company from its competitors. It contributes to higher prices, more customers, and brand loyalty. Establishing such an advantage is one of the most essential goals of a company. In today's world, it is a huge key contributing factor to a business's success. Without it, companies will find it difficult to survive. Overall, look for stocks that are of good quality. Warren Buffett doesn't invest in junk. You typically won't see him buying struggling businesses, regardless of how cheap they become. One of the best Buffett quotes investors can live by is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." To choose the best stocks to buy, Buffett suggests that you should cast out the bad options. If you were given 10 companies that you could potentially purchase, look for the worst companies in the list. This is a simple way to approach the problem of looking for the best stocks to buy. Rather than looking for the best options, try to crash out the bad ones. Our second key principle is to expect volatility and profit from it. In terms of an investor's attitude towards stock prices, most people react in ways that compromises their assets. Their emotions are entirely reliant on when the market goes up or down, and their main understanding is that the stock market is there to instruct them on what the next course of action should be. An intelligent investor should not only expect such instabilities in the stock market, but also try to reap the benefits of such opportunities. Graham, the author of the book that Buffett mentioned, illustrated this with the analogy of Mr. Market, the imaginary business partner of each and every investor. Mr. Market offers investors a daily price quote at which he would either buy an investor out or sell his share of the business. Sometimes he will be excited about the prospects of the business and quote a high price. Other times, he is depressed about the business's prospects and quotes a low price. Because the stock market has these same emotions, the moral of the story is that you shouldn't let Mr. Market's opinions dictate your own emotions, or worse, lead you into bad investment choices. Instead, you should form your own estimates of the business's value based on a sound and rational examination of the facts. Furthermore, you should only make purchases when the price offered weighs out more or makes sense, and sell when the price becomes too high. Put another way, the market will fluctuate, sometimes wildly, but rather than fearing volatility, use it to your advantage to get bargains in the market or to sell out when your holdings become way too overvalued. In addition to this, Graham suggested to practice these 2 strategies to help you mitigate the negative effects of market volatility. Dollar cost averaging. Dollar cost averaging is achieved by buying equal dollar amounts of investments at regular intervals. It takes advantage of dips in the price and means that an investor doesn't have to be concerned about buying his or her entire position at the top of the market. Dollar cost averaging best fits passive investors and alleviates them of the responsibility of choosing when and at which price to buy their positions. Investing in stocks and bonds. Graham suggested distributing one's portfolio evenly between stocks and bonds as a way to protect one's capital during market downturns, while still achieving growth of capital through bond income. Aim to preserve capital and then try to make it grow. You must have 25% to 75% of your investments in bonds and vary this based on market conditions. This strategy had the added advantage of keeping investors from boredom, which leads to the temptation to participate in unprofitable trading. Lastly, Buffett introduces a third principle, and that is to invest with a margin of safety. The margin of safety is the principle of purchasing security at a notable discount to its intrinsic value, which is thought to not only provide high return opportunities, but also to reduce the downside risk of an investment. In other words, when the market price of a security is significantly below your estimation of its intrinsic value, the difference is the margin of safety. Investors utilize both qualitative and quantitative factors, including firm management, governance, industry performance, assets and earnings, to determine a security's intrinsic value. The market price is then used as the point of comparison to calculate the margin of safety. Buffett, who is a staunch believer in the margin of safety and has declared it one of his cornerstones of investing, has been known to apply as much as 50% discount to the intrinsic value of a stock at his price target. In Benjamin Graham's book, it is said that the goal is to buy assets worth $1 for 50 cents. These business assets are valuable due to their stable earning power or simply because of their liquid cash value. So why is the margin of safety important for investors? Well, stock markets are extremely volatile. The rate of stock can skyrocket at one time and can rapidly come down in a single day. For a long time, it has always been a high margin of safety that can protect you from making extreme losses in this kind of market volatility. Warren Buffett has a very simple story to explain the overall concept of this. He refers to the margin of safety with the concept of a bridge. Whenever we construct a bridge, the engineers would always consider various factors of safety. It should be strong enough to bear a load of a 30-ton truck, even though we know that trucks of 10 tons would only be running on it. This is what the margin of safety is all about. It provides a safety net while investing, since the process of investing involves various risks and imperfect information. Buffett himself says that it is impossible to predict things when you are talking about the future. This is where the concept of margin of safety comes in handy. Overall, it isn't unexpected for Buffett to invest in stocks where the liquid assets on the balance sheet were worth more than the total market cap of the company. This means that Buffett was effectively buying businesses for nothing. While he had a number of other investment techniques, this was the typical investment strategy that Buffett learned from Graham. This concept is very essential for investors to remember, as value investing can provide substantial profits once the market inevitably reevaluates the stock and increases its price to fair value. It also offers protection on the downside if things don't work out as you calculated and the business fails. The safety net of buying an underlying business for much less than it's worth was the central theme for Buffett's success in investing. When chosen carefully, Buffett found that a further decline in these undervalued stocks rarely occurred. You can build all kinds of structures based on those three investment principles. Buffett calls this the foundation. He even goes as far as to say that nothing compares to it. That's how highly he commends it. It's important for new investors to understand the basics of investing because obviously this predetermines your success. If you enjoyed this video, consider subscribing to our channel for more. Thanks for watching, and we'll see you in the next one. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!